Thanks, Chris. If the forecast didn't give it away, of course, the Salvation Army holiday bell ringers will let you know it is the season for giving and, of course, donating. It is a great way to help out your local charities, but it also can help lower your tax bill. Well, our money man, Bob Ingram with Ameriprise Financial, is here with some simple tips that we can follow to help maximize the benefit of those charitable donations. And the first question is, with all the the charitable donations that many people will be giving, how do you make sure you maximize that?
Well, of course, you want to make sure you're focused on the charities and the most things that are important to you and where you can do the most good. When it comes to the tax deductions, though, you've got to follow some simple steps and some simple rules. And the first, of course, is you really have to be able to itemize. So if you're an itemizer of when you file your 1040,
sure,
you can take those deductions potentially. If you're using the standard deduction, well, it's sort of built in for you. You can't really do that. If you're contributing, you've got to be aware of the kinds of organizations or charities you're contributing to. So they have to be qualified tax-exempt organizations. And a great way to find out that, you can think of a term, a 501c organization.
We've heard that, yeah.
And the IRS.gov site can be a great resource for that, to figure that out. Also, things like Charity Navigator is a site out there that you can go through, look up the charity. And then the charity or organization itself, find out, make sure you can, they usually have proof. They have forms and letters, charters, things like that can tell you what it is. If you're making the contributions and you want to have the tax deductions for this current year,
okay,
of course you have to do it by the end of the calendar year. So by December 31st to take the deduction in 2013, unlike, let's say, contributions to an IRA or a health savings account where you can do up to April 15th.
Okay, so it has to be within the year that you're claiming. It has to be within the year
you're claiming it. So of course by the end of the year. And then it's important, especially if you have amounts over $250, whether it's cash or donated items, food or things around the house, used items. You want to make careful or keep track of good records. So save receipts. Have a documentation for the specific items. Not that you have to send those in with your taxes, but just in case of any kind of review or audit, you want to make sure you have that. So canceled checks, let's say, for cash contributions, any kinds of record keeping is important there.
Just something to support that you have made this donation, and also that you've made it to a qualifying organization.
Correct. That's correct.
Another point to ask you about is the other charitable gifts that you may have. What are the other points that people often overlook?
Well, a couple of things. If you're not going to contribute just a cash donation, if you have maybe investments as part of your investment plan, you can actually contribute or actually donate appreciated assets. So things like stocks or mutual funds, actually donating the shares. And you have a couple good benefits there if they are appreciated. Rather than having the capital gains, paying that, selling that at some point in time, paying those taxes, if you donate the shares directly, you actually don't pay the capital gains, and oh, by the way, you get a tax deduction. Now, it's a little bit less. It can usually be 30%, up to 30% of the income is the maximum deduction. But it's a great way to do that if it fits into your plan, and obviously you want to make sure your other investment needs are in place. But that can be a great strategy to use, and of course it benefits the organization as well for them, because they don't have to so take the gains on those. And then for people that are 70 and a half, another rule that's been extended and extended and extended as part of these the tax law changes is if you're 70 and a half, you can take money from an IRA up to $100,000.
Okay.
And actually donate it directly. It has to be rolled over, transferred directly from the custodian of the IRA to the organization, but you don't have to pay any taxes on those withdrawals or those transfers. Normally, if you take money out of an IRA, you'd pay income taxes on those and then do what you want with the cash. It can be great for people that have the required minimum distributions who may not want to spend that money, but they have to take that money anyway and pay the taxes on it. This is a great way to move that money and not have to pay any taxes.
Excellent.
And then for gifting, if you're for family, friends, and things, a great part of the estate planning strategies can be for legacy planning. You can gift up to $14,000 a year per person, and it can be even per spouse that you can do.
Excellent advice as always. Thank you very much, Bob Ingram with Ameriprise Financial. We will be right back after these messages.